Good Monday morning. We see futures rising this morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, President Trump says tariffs are coming for aluminum and steel. The president plans to impose 25% levies on all imports of the metal. That news is boosting steel stocks. It's boosting the dollar. It's stoking gold, which is now at an all-time high, all ahead of inflation data and Chair Powell's testimony on Capitol Hill coming up this week. Meanwhile, on the corporate front, one of the world's most aggressive activist investor targets BP as McDonald's serves up strong international results. Let's take a look right now at where markets are trading. We do see futures up across the board. In fact, right now, S&P futures trading at 60.86. That's where they closed on the day I left here for vacation 2.5 weeks ago. So nothing's changed in that sense. NASDAQ futures gaining almost 1 full percent, 21,788, as a number of hyperscalers have boosted their CapEx targets to build out internet infrastructure this year. And the 10-year yield, this is, Sonali, where you've pointed out, we have seen a little bit of a change over the last 2.5 weeks. We were at 460, now we're at 448, so down about 12 basis points in that span. Today, down 1.5 basis points. Check out gold. Dan Curtis, our producer in London, put together this chart, and he always does it in logs so that it's meaningless to most of us. But the point is, back in 1973, when the Treasury marked its gold holdings, 260 million ounces, I believe, it was trading for $42.22. And that's what the Treasury still values its gold holdings at. Today, we're at $28.99. We've been over $2,900, a record for gold prices. If they were to revalue those holdings, they could, through repurchase agreements, get another $750 billion from the Treasury, and then they would have to issue fewer bonds this year. A
lot of value in the things you could hold, not the financial instruments, but gold, steel. Let's take a look at what's moving under the hood. You mentioned those steel stocks were rising. Nucor among them, up more than 6% pre-market. There are others as well, but they're moving higher after those plans that Trump had announced for 25% tariffs on all imports of aluminum and steel into the United States. We're also looking at BP because activist investor Elliott, the most feared on Wall Street, they built a stake in the British energy giant. We're going to discuss it later this hour, but you can see that the market does like it. Up another 6%, almost 7% pre-market. McDonald's sales in the U.S. were light, but internationally they were strong. The global sales growth was for the first time since the middle of last year. Sales, though they dropped in the U.S., they were offset by Japan, Middle Eastern markets. McDonald's now up almost 2% pre-market. Matt, we're in the middle of earnings season still.
Kind of smells like McDonald's. I feel like somebody may have brought a bag of McDonald's
just
food
in your head
in the studio. Let's talk about the spending that the hyperscalers plan to do, Sonali, because while I was away a couple of weeks ago, there was a story out that DeepSeek could do the same thing that OpenAI does with ChatGPT or Google does with Gemini, but for a fraction of the price. And I thought, wow, that's a big deal. Over the last couple of days, we've seen the 4 biggest spenders on AI infrastructure boost their CapEx plans even more. So DeepSeek says we can do this more efficiently, and American tech companies say, no, we can spend even more money.
Yeah, they sure did. And you have Amazon among the chiefs of them here, as you saw in that chart. What's fascinating to me is that you've seen this market melt higher still, even though NVIDIA is actually down on the year. So you're seeing the big tech companies really benefit with this competition in AI. Of course, over in Paris, there's a big conference going on right now. We're going to bring some details throughout it. But the big story still is what we're seeing on the tariff story, even with, and I just have to note, it's a big week of data ahead. I know this morning you were asking who's watching anymore. I think we have to.
Yeah, how much does CPI matter? How much does the Fed matter to this market? These are just questions I was posing because there was a time when that was the only thing that mattered, and it wasn't too long ago. But now tariffs obviously are front and center. Trump has suggested he'll put 25% levies on steel and aluminum from any exporter, or I guess importer from our point of view, you. Bloomberg Steel reporter Joe Doe joins us here on set, Joe. And I find this absolutely fascinating because we've seen this before. It's happened, and it was helpful for about a year, caused a spike in prices before they then collapsed again.
Yeah, exactly. 2018, the tariffs finally came in because they deliberated for about a year over it. And the steelmakers had a nice benefit through like June of 2018. And then after that, it was kind of moving back downwards. Here today, obviously, you see all the steel names are up. All the, the two aluminum names that are American domestic producers are up. I think the thing to remember, though, on the move is that these steelmakers have been absolutely battered. Last year was the worst year that the American steel industry has seen stock performance-wise since the first Trump administration. So there is a little bit of room to grow. I was talking to a couple of contacts last week. There was a big steel conference. Everybody was expecting Canada and Mexico steel tariffs. Then they didn't get them, and the mood had turned very dour at the conference. Now suddenly back on. I think long-term, it's yet to see what really happens here. I think one thing for everybody to remember is the bottom line, what the steel industry cares about with the tariffs, is capacity utilization. If capacity utilization is 80%, they say they're fine, our profits are good. It's not really about jobs.
Let's also look under the hood here. As you mentioned, a lot of the steel companies in the U.S. are rising this morning off of a low base, as you mentioned. Who stands to benefit most? What does the plumbing look like under the surface? If this were to happen, how does that benefit start seeping into these companies?
You're going to see Nucor Corporation, Steel Dynamics, U.S. Steel, and Cliffs all benefit in the near term. Prices are going to go up for them, obviously, because prices actually are going to go up for consumers. The service centers will probably benefit from this. Those are the middlemen who actually buy from the steel companies and then sell to the actual consumers. But beyond that, we're going to have to wait and see actually who does benefit. It is reasonable to think that costs are going to start going up.
But at the end of the day, it looks like a lifeline. This is what we were talking about this morning for U.S. Steel. Really, Nucor and Steel Dynamics are going to make even more money because they don't use the coal blasting furnaces that U.S. Steel, the old school techniques, right?
Yeah, I mean, obviously Nucor and Steel Dynamics mini mills, I mean, they're going to have a huge benefit. I do also think you will see a pretty decent benefit for Cliffs and for U.S. Steel, the blast furnaces, as you mentioned. And of course, U.S. Steel, this is probably good for them because the president effectively said, there's no way I'm allowing Nippon Steel to have a majority ownership in this company, which upset a lot of investors who are still looking for the $55 a share. So at least these tariffs coming in may give some reprieve. And listen, that's what Trump said he was going to do for U.S. Steel back in December. He said, why does anyone have to own U.S. Steel? We're going to give them beautiful tariffs. And that seems to be what he's doing today, at least.
All right, Joe, we'll continue to talk to you as this story develops. Joe Doe covers the steel industry for us at Bloomberg. Joining us now is Samir Samana, head of global equities and real assets for Wells Fargo Investment Institute. Samir, great to have you on the program. What do you think of this tariff news? You know, we've seen so many stops and starts on tariffs. I thought, you know, they would tank the market when we were looking at potential 25% tariffs on Mexican and Canadian goods, but the market seems to take it in stride. Really, it doesn't seem to push the S&P down too much.
Yeah, I mean, much of it comes down to sequencing. You know, what we've told investors is, look, focus on the direction of travel, which is, you know, net, you're going to see higher tariffs. At some point, they're going to lead to higher inflation prints. Maybe not the number later this week, but at some point, you're going to see higher inflation. As you mentioned, you know, you're going to see consumers pay more for a wide variety of goods. And then at some point, the Fed's going to either not cut at all or maybe even have to talk about, you know, raising interest rates. So, you know, I don't know how much time it's going to take to get from, you know, call it point A to point B from the standpoint of inflation becomes a real problem. But that's kind of what we're thinking. So, you know, how should investors, you know, kind of think about it? You're probably going to see rates go back up to recent highs. You've seen gold continue to kind of climb higher. The dollar's been climbing higher. We think all those things will continue to kind of drift upwards.
Samir, what does this mean for the CPI print expected on Wednesday? This is, of course, the first inflation print since the inauguration. But to your point, a lot of what you're talking about, this potential increase in consumer prices, you may not see until later down the road. Do you think the most recent, this upcoming PPI, CPI print will show any signs of stress?
It's probably a little too early. Now, that being said, I know a lot of, probably producers were trying to run ahead of any potential tariffs. So, growth was pretty good in Q4 and in January, and a lot of people kind of stocked up. So it's possible. But really, I think what I would focus on is those one-year kind of inflation swaps, which are threatening 52-week highs and even breaking out a little bit. I think that's where the real game is being played on inflation expectations. And then you saw, last week, consumer inflation expectations are already, starting to take higher. So I think that's what I would keep my eyes on.
We're going to talk to our reporter Natalia Knijevic later on in the program about hedge funds upping their purchases of stocks at the fastest pace in 3 years. Consumers, retail investors also were going gangbusters buying stocks last week. And institutions, foreign investors, all fully invested. If you see room to run for the S&P 500, where's that marginal buyer coming from? Where's that marginal dollar coming from?
Sure. So we do see, additional room for the S&P to run. Our target for year end is 6,600. A lot of it will come from corporates, right? You're about to exit kind of the buyback blackout window, and this was another really strong quarter of revenues and earnings, and I think Q1 will be even better than Q4. So I think a lot of it does come back to corporates, but then I think also just there's kind of an ongoing, healthy labor market, so people keep getting, more cash to invest as their paychecks come in. They probably save a certain amount of it, but you are right in terms of this market could probably use a breather. So to the extent that flows kind of wax and wane, you probably are in a period where other than corporations, probably everybody else is kind of in the pool.
What's the setup here? Because you do see a trade back into that large cap tech trade, but the Magnificent Seven has actually been choppy overall. If you look this year, they're actually still down on the year, even if you've seen the S&P rise. What's going to create leadership for the market in the next month or so?
Yeah, great question. So I think big picture, I think an upward chop just in general for the broader market is really kind of the playbook for this year. So you'll get these really nice rallies. You'll probably want to sell some of them. You'll probably get these really nice pullbacks. You're going to want to step in and buy. We do think large caps continue to outperform small caps in the U.S. And then we like anything but defensives. And what that means is we like energy. That's our most favorable. We like financials. We like industrials. And we like comm services, which has had a great run. But if you were to tell me, hey, look, tech has lost leadership, what's taken its place? Probably the easiest, cleanest story to tell right now is probably financials. When you look at the level of interest rates, when you look at the fact that there's a little bit of steepness in the curve, I think that's probably where the leadership starts to evolve as we get into the later part of the year, when it might seem like, maybe if inflation comes down to the Fed can cut, or the other one would be industrials. We really do think that, the U.S. manufacturing side is starting to improve. They're catching up to the consumer side, and that could be a really nice catch-up trade.
Samir, we thank you for joining us this Monday morning. That is Samir Samana of Wells Fargo Investment Institute. And coming up, we're going to head over to Paris. We're going to talk about the Paris AI Summit. We're going to hear from OpenAI's Chief Global Affairs Officer with our own Tom McKenzie. You're not going to want to miss it. Stick with us. This is Bloomberg.
Let's get now to high interest, a look at what's reading on the terminal. President Trump is suggesting that Elon Musk's government efficiency team found irregularities while examining data at the U.S. Treasury Department. It wasn't immediately clear whether the president was talking about U.S. government debt, because he said treasuries, or payments processed through the Treasury Department, and he didn't elaborate on what problems Musk found. But we are waiting with bated breath to find out ourselves. Also, Google's AI chief is calling out DeepSeek for its claim of spending under $6 million to develop its artificial intelligence model. Demis Hassabis, who is the boss of Google DeepMind, also shot down the idea that DeepSeek's emergence upends the economics of AI development. He spoke to Bloomberg at the Paris AI Summit earlier.
First thing to say is it's a very impressive model, a very impressive piece of work. I think the team is probably the best team that I've seen come out of China. So that said, I think a lot of the claims are exaggerated and a little bit misleading.
We're going to now head over to the AI Action Summit in Paris, where Bloomberg's Tom McKenzie is sitting down with OpenAI's Chief Global Affairs Officer, Chris Lehane.
Guys, thank you very much indeed. Yes, at Le Grand Palais in Paris. And I'll start with that question about DeepSeek, because it is a key question for people attending this event. Chris Lehane, Head of Global Policy, of course, at OpenAI. DeepSeek, how do you characterize the impact of DeepSeek? We're just hearing from Demis Hassabis, who I sat down with earlier. He said their claims around the way they built and trained this model, the cost and the amount of chips they were using, he says that's exaggerated.
So I think there can be two things that are true here. One, that they have built a really impressive model. It basically competes with what OpenAI had put out back in September. Now we've since put out other more advanced models, but clearly a very capable model. I think the second thing, what Demis said, can also be true, which is perhaps, and we've seen news reports on this, that the costs, that how the technology was derived, that whether they access certain types of chips, whether what was initially said was not actually the case. I do think the big takeaway, though, even if everything I just said turns out to be accurate and true, it is still a very impressive and competitive model. And so, to me, the big takeaway in all of this is that this really reaffirms something that OpenAI has been saying since the summer of 2024, that there are two countries in the world that can build AI at scale, the US, the CCP-led China. Yeah. And what that really means is that there is a global competition right now between whether the world's going to be built on small d, democratic AI rails, or authoritarian, autocratic AI rails, and that's the big takeaway from this.
I want to get to that, but I want to push you on what your team have discovered, because I know there's an investigation, there has been a probe within OpenAI as to whether or not DeepSeek inappropriately used some of the inferencing data, distilling from your own models. Have you come to a conclusion on that?
We're still looking at it. Obviously, we've already made public that we had seen some evidence of that taking place. And just so folks understand, because distillation is not a normal word, that, at least certainly that I don't use at the breakfast table all the time, there is different kinds of distillation, and I'll use an analogy. If you go to the library and you take out a book and you learn from that book and that ultimately informs some of your work, that's fine. That takes place all the time. That's part of what happens in the AI space. There's another version of it where you go into the library, take the book, keep the book, put your name on the book, slap a cover on the book, and hand it out as if it's your book. And that's the replication, and I think that's what we're concerned about. And again, what we've seen some evidence of and are continuing to review to have a better understanding. We've talked with government officials about it, and we'll share more as we learn more.
Yeah, of course. Well, OpenAI's critics have said, you guys trained your models on data and you haven't been fully transparent in terms of the use of that data. And I know you would push back.
That's right. There's good calories and bad calories. There's good distillation and problematic distillation.
Have any of your customers pushed back and said, look, we're uncomfortable with the pricing of your models at this juncture?
Well, let me put it this way. OpenAI came out in November of 2 years ago, 2022, right? And within 2 months, was it 100 million users, right? We're well over 300 million today, continuing to see, that really strong growth. And what we try to do is have different models priced at different levels depending on how you ultimately want to use it. And it's something, just given the nature of how fast the technology is moving and the pace that it's moving at, that you're always constantly trying to evaluate.
Prices go down from here?
So I think amongst the most interesting things that we have seen, this is an interesting aspect, which is the efficiencies of systems, particularly using the reasoning technology, is coming down. Sam Altman, our CEO, put a blog out last night, maybe technically this morning, I don't know, but some point in the last 24 hours, that sort of looked at 3 observations of AI. The first was that the more you spend on compute to build frontier models, it's pretty logarithmic, the more powerful those get. So you're going to require more and more compute, more and more investment in infrastructure. Secondly, that over the last year or so, we've seen a big increase in efficiencies, which are bringing down the cost of a token of that. Think of a token as a price of compute, as a unit of compute, about 150%. But even as the costs come down, the amount of people using it go up. So that then puts pressures back on compute. Like an analogy here is car prices come down, more people drive cars, but you then need more energy, more roads. Third piece that has come out in his observation, sorry, just bear with me for a second, is that the economic productivity that you're getting is super exponential.
Where are you getting the money to spend? 100 billion initially on Stargate. Elon Musk says you probably don't have the money. Even Satya Nadella says we're good for our 80 billion.
Yeah.
Where's your 100 billion?
So, first of all, we have incredible partners. We have SoftBank, which is a proven track record of raising enormous syndicated money from sovereigns and pensions
Up to 500
and
billion.
others.
How much of that is coming from OpenAI?
And then we have Oracle, right, which actually builds these. Then you have OpenAI. What our piece of this, first of all, in terms of the media question, there's 100 billion that's going to be going out the door in the immediate future. We already have a facility in Abilene. You guys need to come down. You can, Abilene, Texas, sorry.
Yep.
We'd love to give you guys, you can hang out. The Oracle guys have done an awesome job down there.
You're dodging my credit.
No. I want you to come see it.
I'll come see it. How much are you putting?
We're not going to show. We like to show, not tell.
Yeah.
And then the OpenAI piece comes in two different pieces here. And I think this is to understand the economic model here. First of all, what we bring to this is the IP. And you can think of compute the same way maybe you can think of gas. Regular gas, medium gas, and then premium gas. The premium gas is what people are going to pay for. The premium compute is going to be the most expensive compute in the world because it's going to be the highest level compute. You only get that premium compute with our IP. IP going into the chip design, IP going into the data centers, IP going how the clusters are sort of structured. And then we also are a buyer of the compute, right? So we commit to buying a certain amount of the compute that's coming out, which helps the whole economic model work.
Chris, you worked in the Clinton White House. Is the Trump administration...
I had a lot more hair than, by the way.
Are they right? You've got a great hairline. Is the Trump administration right to slash AI regulation?
I think what the Trump administration is focused on is one thing, and one thing very clearly. Who is going to prevail in the competition between Democratic AI and autocratic? That's what they get up and think about every day, at least from what I have seen and from what I have heard. And so I think they understand that you do have to really be leaning into the innovation. If you think about where the sort of comparative advantages are, right? At the end of the day, this is actually pretty simple. Whoever has access to compute is going to be in a strong position. What makes up compute? It's data, it's energy, it's chips, and it's talent. Right? And if you think of what the PRC has, they have an enormous amount of data, authoritarian state, energy, 10 nuclear facilities last year, another 10 coming on this year. Our chips are better. They're throwing a ton of money at it. Talent, and I think the talent piece is really interesting because they do have great talent in China, but in capitalist systems, it is capitalism that unleashes the developer, the builder, the entrepreneur, the people who are actually making this stuff into tools that solve hard problems, and that's where our advantage is.
Is that why you've joined up and partnered with Andrew? And I'm just thinking of the AI principles of Google. They've adjusted them, and Google is no longer ruling out building tech for defense, for the military.
Yeah.
You're signing up, you partner with Andrew. How far does that relationship go? How much are you prepared to embed tech into weapon systems?
Yeah, and we also just announced a partnership with the national labs, which are which play an incredibly important role in how the U.S. government thinks about national security issues.
But on defense.
Yeah, yes, and the labs, obviously like Los Alamos and others are very big players in the broader national security ecosystem. So, for us, right, we do want to be a partner on innovation with government. We do believe it's incredibly important that democratic AI prevails, and that means making sure that the government is getting access to the highest capabilities. We'll certainly do it consistent with our values and our principles, but at the end of the day, we do believe it is very consistent with a mission that is to make sure AI benefits everyone, that you're ensuring that AI is going to be built in a democratic way with democratic values.
Chris Lehane, thank you very much indeed. Global Head of Policy at OpenAI. Guys, back to you.
All right, thanks very much. Tom McKenzie there at the AI Summit in Paris. We are looking right now at a market that continues to rise. We're seeing steel stocks, particularly Nucor, Alcoa, U.S. Steel, all catch a gain on the suggestion of tariffs coming up. We're going to have coverage, by the way, continued coverage of that AI Summit throughout the day, so stay with us if you want to hear more about that. The AI spend also a huge part of this story. Eric Lombard, the French finance minister, do they have any money?
Enough to spend to go to the AI show. We're also going to speak to Marty Chavez of 6th Street. He's going to talk about AI and investing. Remember, he used to be the former CFO of Goldman and Chief Technology Officer there. We're going to talk about how it's going to change finance next. But we are just ahead of the opening bell. Stick with us. Futures on the rise. This is Bloomberg.
We are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on futures. They're up on the threat of tariffs. What a world we live in. S&P futures gaining 0.5% here, back to exactly the level that they were when I left 2 weeks ago this office. The NASDAQ futures up even more, 0.8%. The small caps splitting the difference. In terms of the opening bell, you can see on the New York Stock Exchange, American Healthcare is a REIT that went public last year. They're up more than double since they started trading, about 144% the gain. On the NASDAQ, you have Novocure, which is an oncology company looking for a cure for cancer. I looked at their stock over the last 5 years, down 75%. So I hope they do find the cure for cancer because they're not making anybody rich right now. In terms of the major averages, right now you can see the S&P, the NASDAQ, and the Russell trading just about where futures indicated. So 6,056. It seems like we have so much news. There's so much going on in terms of Department of Government Efficiency, tariff announcements, firing federal workers, and yet the market stays exactly where it was. Stocks to watch, the steel tariffs really pushing U.S. producers higher, as you would expect. U.S. steel maybe needed a little bit of a lifeline, although the stock has been doing very well over the last few years. But 38.30 is where it's trading right now, still far off from the $55 offer from Nippon that looks like it's never going to happen, but never say never is what I'm really learning in this administration. Cleveland Cliffs up 10%, 11%, so big gain for them and a gain for Alcoa as well on the potential lift in prices that manufacturers are going to have to pay them for their products.
Yes, certainly interesting to watch. You have it even more on the rise now. Cleveland Cliffs up more than 12%. Also, potential deal activity, nothing to say of that even just for today, but certainly moves from the White House. They like it. We're looking at some other things too. We're looking at Lyft under the surface too, up more than 5.5%. It plans to launch robo-taxis as early as 2026, according to one report. They will launch in Dallas and be powered by Mobileye, which of course is on the rise as well, up more than 13%. Also want to take a look at ON Semiconductor because the forecast missed analyst estimates. The CEO is citing uncertainty for 2025. Quarterly revenue dropped 15% year over year, but full year free cash flow tripled in 2024, yet you're seeing it down more than 4.5% as the market opens. Matt, we are still in earnings season.
Yeah, that's so exciting, earnings season, but not nearly. Look, the Fed and earnings, do they matter as much as these tariff announcements?
They matter. When you can't trust anything, you stick to the facts, you stick to the numbers.
Back to the basics. Okay, let's bring in New Edge Wealth Chief Investment Officer Cameron Dawson. She joins us here at the desk. And Cam, it's great to have you today because you actually in your previous life were an industrials analyst. So we have this news on the potential of tariffs, and when I saw the announcement, I instantly thought of 2018 when the exact same thing happened. It's like deja vu, which was awesome for U.S. Steel for a little bit. Until it wasn't, right?
And it certainly caused huge disruptions throughout supply chains. When we thought about overall industrial production, it actually caused it to fall and contract. PMIs went negative as we got into 2019. So these tariffs, even when they were very focused back in 2018 and 2019, very different than the broad tariffs that are being discussed today, we saw them very much weigh on industrial sentiment and activity on the stocks in 2018. They did better in 2019 as they anticipated a bottom, but I think it's important to remember that these tariffs do come at a cost because of the uncertainty.
Speaking of the uncertainty, you had just a couple of weeks ago. Were you here when he threatened the Canada and Mexico tariffs?
No, but I was watching. My jaw was on the floor waiting for us to tariff our two biggest trading partners.
Right.
Didn't happen.
It was a negotiation. One question we've been having is what is the impact? When you have the threat, you do have some movement under the surface. You have some companies moving around supply chains in order to prepare for what may or may not happen. How do you prepare?
The hope. That's the hope that they're moving around supply chains. Are they actually doing it?
You do see it in some of the port activity, for example. You see people kind of front running some of the things that might happen. So how do you take account for what is actually happening versus what might happen?
Well, we haven't necessarily necessarily seen a big influx or that hoped for manufacturing renaissance. So they might be pulling forward activity. Doesn't necessarily mean that they're significantly changing where supply chains are located. And we would ask the question of...
It's inventory.
Well, yes. And if you haven't changed your sourcing locations after the first round of tariffs in the trade war, after the pandemic, after the closing of the Chinese economy for multiple years, what more do you really have to move in the ability to shift around? So we do think that if you do apply something like a universal tariff or those reciprocal tariffs that are being thrown out, that there's a lot of things you can't change production of simply because you don't produce them in the U.S.
Right.
Think about fish and avocados and
I
bananas.
always think about cars, right? Because, well, first of all, I care about cars, but I think Stellantis produces 40% or builds 40% of its vehicles in Canada and Mexico. GM more than 30%, Ford 25%. Even with the threat of tariffs, they weren't like, okay, we'll shut down our plants in Ontario and move them back to Michigan or Indiana or Kentucky, wherever they are. So, but the bottom line is these things drive up prices, right? For example, when steel prices go up 25%, those companies that need to bend metal are going to have to charge consumers 25% more. And there was a CBS poll. Did you see this yesterday? 52% of Americans approve of the job Donald Trump has done in his first 4 weeks in office, but 66% are worried about inflation. We're getting CPI. Sonali's going to pay close attention. The Fed obviously cares. Does it matter?
It certainly matters. The administration's been talking about two ways that tariffs aren't inflationary. The first one is that consumer preferences will react, meaning if you raise prices in one place, they'll be able to find spending in another. The other one is through the currency channel. But all of these things take time. They're not immediate reactions. And you saw it in the University of Michigan data that showed up on Friday that showed this big, huge jump in inflation expectations. And the Fed is concerned about that. Go back to the summer of 2022. In 2022, the Fed did its jumbo hike. And the reason it did its jumbo hike is because consumer inflation expectations popped in that UMich survey. So they are concerned that if you do see rising prices, that inflation expectations could become unanchored. And that's something that the Fed really doesn't want to see. And it does speak to just the psychological component of inflation as well, of how some of these things can become self-fulfilling prophecies.
We sit next to each other, Sonali and I, even offset. And she was saying, CPI, there's data coming out. And I was like, does it matter? It doesn't feel like the Fed matters to this market as much as it did
But is it even just about the Fed? If you have inflation expectations rising, that's a self-fulfilling prophecy, isn't it?
Well, I do think that the Fed is more of a reaction to what's happening within markets and the economy versus a driver of what's going on in markets and economy, which is very different than the last few years where the Fed very much was the key source of kind of volatility within markets. We think that's because policy is a bigger impact because of where we are in this cutting cycle. We think the Fed is effectively on hold, that the labor market is giving them no reason to change where policy is today, which just means that they're taking a back seat to these other headlines.
Well, to the other headlines, it's earnings season.
Knew it. Knew it.
It matters. It matters for a different reason. And this is, I'm going to build a case for you. Yeah. If you have inflation potentially rising, or at least inflation expectations, you're in an earnings season where DataTrack pointed out this morning, you're doing better than the 10-year average, but not as good as the 5-year average in terms of how much you're seeing beats in terms of companies that have reported earnings so far.
It's always
the margin
75%.
Of beats. Yeah. So if you have inflation, then at what point do we start worrying about margins again? People seem to be very happy with all the CapEx spend and any other types of spending, but when does that end if you're starting to see prices rise?
Well, maybe you're starting to see a little bit of evidence in it in the 25 and 2026 numbers. They've been revised lower by about 1% to 2% each one over the past couple of weeks as we've moved through earnings season.
So in aggregate, are we still expecting like 14% earnings growth for this year?
Still expecting that mid-teens earnings growth. However, it's just slightly lower than it was when we started this earnings season, which means that even though fourth quarter numbers are coming in much better than expected, you went into the earnings season expecting 12%, you're getting 16% growth. That's great news, but what you're seeing is analysts start to cut those out-year numbers, and that's super important to watch because that rising 12-month forward earnings estimate has been the key underpinning driver of this rally for the last 2 years.
So are you bullish this market, Cameron? I mean, we were talking with Samir Samana earlier from Wells Fargo. he expects gains in the S&P 500, even though everybody's fully invested and has already piled in, right? He says corporate buybacks are going to drive it higher.
Our estimate is, our expectation is for a wide, choppy range. We're calling it the talking heads market, that the market's on the road to nowhere. And this idea that you have to grow into these high valuations, you have to grow into stretch positioning. It means that the best you get is earnings growth because you're starting at such high elevated valuations and there's not nearly as much money on the sidelines. Look at individual household allocations to equities. They're at all-time highs in the Fed data. They're at nearly 20-year highs in the AAII data. There's just less room for people to be drawn into this market.
Institutional allocation and foreign investors.
Exactly.
I mean, they're all...
How exciting is a market when gold is the top trade?
I love the gold. Did you see the gold story in the Financial Times? Gillian Tett wrote a piece that said maybe Treasury is going to mark to market its gold holdings, which it currently marks at $42 an ounce.
This was a half an hour of my morning. Cameron, thank you so much for joining us today. Of course, it does set up for an interesting market. That is New Edge Wealth Chief Investment Officer Cameron Dawson. Now, coming up, people overseas are loving it. International sales boost McDonald's this quarter. We're going to bring you more on those results next. This is Bloomberg.
It's time now for our top call. Some of the analyst action in focus for us this morning. First up is Kraft Heinz, no longer a buy at Mizuho. It's getting downgraded to a neutral after the analyst says the shares are weakening thanks to softer store volumes. Next up, TD Cowen says Merck is no longer a buy. The firm says it doesn't see viable arguments for the drug maker's outperformance. It also cited reduced growth prospects. And finally, Bank America upgrading Mobileye, saying it's no longer a sell. The firm cites positive catalysts this year thanks to contract wins with several automakers. Meanwhile, as Sonali was saying earlier, Lyft announcing it will launch robotaxis not until next year, but it's going to do it starting in Dallas with Mobileye technology. Sonali?
And we're looking at McDonald's. The stock is higher after international business drove sales numbers higher. U.S. sales, though, slipped in the quarter as the fast food giant contended with an E. coli outbreak. Joining us now with more insight, Michael Halen, senior restaurant analyst for Bloomberg Intelligence. You look at the numbers, you look at their plan to spend more. How do you feel about what's being put on the table here? Is the weakness in U.S. sales something to look at in the year ahead, even if the international sales are rebounding?
Yeah, so the focus of the quarter really was the recovery post E. coli, and so we got pretty good news there. December traffic was positive, which I think was much better than most had expected. They talked about a little bit of a bumpy January, but they expect a full recovery in U.S. same-store sales by the beginning of the second quarter, and the street is taking that as very good news.
I got to ask about the quality of the food that they're serving up, Michael, when we have Bernie Sanders agreeing with RFK Jr., that America faces a real problem. The food that we grow and sell to our people is poisoning us. Is McDonald's changing, the menu to make people healthier? I know they always kind of feign that, but is there any chance they actually do that?
Well, I think the fast food chains are giving people what they want, right? They want convenience at a strong price, and a lot of Americans, to your point, are not looking for much healthier food. Who knows what we'll see if RFK gets nominated, and if there'll be some changes in regulations around the food that restaurants are served, but a lot of that onus will also fall on the food manufacturers, right? McDonald's is not vertically integrated, and so, they may be working on reformulations of some of their items now as we speak in preparation, but we don't expect a huge impact to their business.
Can we just talk a little bit more about price here as well? Because you saw that $5 meal really take off. You saw others really instated as well. You saw them also offer different promotions like, Canadian dollar, $1 Canadian dollar coffee, $4 Euro Happy Meal, of course, over abroad in France as well. how long do these promotions continue? At what point do they become a more permanent staple for consumers that are still looking really for a deal?
Yeah, well, listen, you know, the quick service industry is heavily exposed to low-income consumers, right? And low-income consumers are most impacted by all the inflation that we've seen for the last 4+ years, right? And so for that reason, you'll continue to see quick service lean pretty heavily, you know, on value, right? And McDonald's especially pushed pretty hard in the third quarter on value, and it improve their traffic, right? And so it's working to help turn around that business. You know, next, you know, on their agenda is going to be, once same-store sales are fully recovered from E. coli, is to start with new product news and amplify those new launches with more marketing, right? And so snack wraps, chicken strips, you know, continued LTOs of the Chicken Big Mac, all that stuff is going to be pushed out later this year to help drive, you know, better same-store sales, and you know, they'll be spending on marketing to amplify that. But it's going to be a barbell strategy, right? Value is going to constantly be a big part of McDonald's and QSR strategy, because about 30% of their consumers are low income.
Sonali, have you seen Baraka?
No.
You know, the 1990s art house film that showed factory farming chicken farms?
Is this another movie you're going to make me
It's terrifying. It's terrifying to see. I mean, when you mention the Chicken Big Mac, Michael Halen, and I shudder to think how those chickens are raised. When Sonali said price, I thought she was talking about the stock. It's trading at over $300 a share, but it's really underperformed the S&P over the last 5 years, over the last 1 year. And we were talking with an analyst this morning who said the marginal buyer is going to be the company itself, right? Are we going to see more stock buybacks? Does McDonald's have capacity to give more money back to investors?
They do. They're under-levered compared to some of their restaurant peers, and you know, being so heavily franchised, yeah, they have plenty of capital to deploy in stock buybacks. So yeah, the answer is yes there. You know, I would just say, just in general, it's harder to get excited about QSR this year than fast casual, and then even casual dining. And the big reason why is what I mentioned earlier, is that pretty significant exposure to the low-income consumer, right? In terms of asset prices, a lot of them are at all-time highs: gold, S&P, home prices, all that stuff. And so upper middle and higher income consumers are feeling pretty good and spending more, right? So the chains like McDonald's that have high exposure to low-income consumers, and also international chains that have a lot of exposure to Europe, who's getting hit even harder with inflation and seeing even a larger slowdown by low-income consumers, right? I think we'll probably underperform this year.
Mm-hmm.
All right, Michael, thanks very much. Michael Halen there at Bloomberg Intelligence talking to us about McDonald's. You're looking at these, you're looking at the NASDAQ. You're chomping at the bit to give us a market check.
Ripping.
Yeah.
Well, you have your biggest gainer is actually Trade Desk, which is really interesting after a Super Bowl day. Of course, people thinking about advertising, people thinking about streaming. But NVIDIA is also up quite meaningfully today. You have the main supplier of AI servers saying that sales were strong. They strengthened their first quarter outlook. You're seeing NVIDIA rise in synchrony. You're off of session highs for that NASDAQ 100, but you're up almost 1%. So looking pretty good. But gains across the board there. S&P 500, Russell 2000 also up, Matt. Coming up, though, we're going to look at one particular stock. We're going to look at BP. It's jumping after Paul Singer's Elliott takes a significant holding. We're going to take a look at the implications next in the Wall Street Beat. This is Bloomberg. Time now for the Wall Street Beat. BP shares are surging after Paul Singer, one of the world's most aggressive activist investors, built a stake in the company through Elliott Management. Here with more, Bloomberg's Will Kennedy. BP has been struggling with years of underperformance, really. What is it that Elliott wants them to do that has investors excited at the moment?
Well, we don't know exactly what he wants them to do, but one of the criticisms of BP's strategy has been that the strategy set by the previous CEO, Bernard Looney, to really reorientate the company towards the energy transition, to pare back oil and gas production, to invest in new energies has backfired. And a lot of investors don't like that strategy. The share price, as you say, has underperformed. And I think the expectation is that this activist will push BP further along that path. It already started to go back to its traditional business, but really concentrate on oil and gas and perhaps lose some of those new investments and just refocus on its core.
Yeah, I'm looking at the shares. Will, I always pull up a comp chart. I feel like the 5-year default is just a great timeline. BP is down almost 7%. Meanwhile, Exxon is up 82%. And that's not even, including buybacks. What are they doing wrong? Why is Exxon doing so much better?
No, it's a pretty stark contrast, as you say, and it also holds true to a slightly less extreme extent to Shell, which is the other big UK major to which it's often compared. I mean, it started going all the way back to 2010 when they had the Gulf of Mexico oil spill disaster, and there have been a series of missteps since. It had to write down a huge investment in Russia after the invasion of Ukraine. It then lost Bernard Looney as CEO. He had perhaps lent too far into the energy transition on the back of falling demand during the pandemic, and you put all these things together, and it's a pretty sorry tale. That said, there are a lot of fine businesses still in BP. It is a world-class oil and gas company. It's very good at trading oil and gas. It has an enviable position in the Gulf of Mexico. And so it's likely that that's why Elliott sees the value there, that it wants to unlock the good parts of the business and get past some of the strategic missteps.
All right, Will, thanks so much for joining us. Great to get a little bit of time with you. Bloomberg's Will Kennedy has been covering these businesses for years, dare I say decades.
Yeah, it's been a tough start for the new CEO as well, but we know Elliott wants fast change.
Yeah, that's right. Auchincloss needs to get with it if he's going to satisfy Paul Singer. Coming up in the next hour, Marty Chavez joins us from 6th Street on his AI bets, then Anna Paglia from State Street on ETFs. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today. And coming up, Trump says tariffs are coming for aluminum and steel. The president plans to impose 25% levies on all imports of the metals. And that news is boosting steel stocks, the dollar, and stoking gold. All ahead of inflation data this week and Chair Powell's testimony on Capitol Hill. And the rise of DeepSeek is forcing global investors to reevaluate their AI strategy. Wall Street veteran Marty Chavez weighs in just a moment.
Let's get a check as well on what's going on in markets. Tariff threats, you would think, have a negative effect, but really they're having a positive effect, especially on steel stocks. You see them all bouncing back. Cleveland Cliffs was up like 12% at the open, so even more than U.S. Steel and Alcoa. You also see NVIDIA putting up a strong performance. It's the biggest point addition to the S&P 500, of course, with a $3.5 trillion market cap. You'd expect that. But the NASDAQ is up 1% as those tech stocks rise. And the U.S. 10-year yield continues to fall. It's only 2 or 3 basis points, but it makes Sonali more relaxed to see us out of the danger zone.
As long as we're under 4.5, I think we can survive.
Okay, let's get over to Natalia Knezevich right now to take a look at positioning for hedge funds, because it was a banner week last week, Natalia, wasn't it?
It was. We saw that hedge funds bought U.S. stocks by the most in 3 years, and that was a pretty significant change in sentiment. Most U.S. sectors were not bought. We saw big inflows into materials, healthcare, but what really stands out is information and technology. Hedge funds reversed their bearish stance on infotech and bought technology shares by the most since December 2021. So we've been waiting for this move for quite a while. What is also interesting is that until recently, they were more constructive on software stocks. Now we see that they are buying semiconductor stocks as well. And Goldman's Vincent Lin, who tracks this data, he's saying that hedge funds potentially are becoming more constructive on U.S. stocks and tech specifically.
Natalia, what do the options say? Let's look at the change in sentiment we're seeing under the surface, too.
Right, so just last week, guys, we spoke about bearish sentiment in the options market when it comes to tech stocks. This chart is a good explanation. It shows that demand for protection, demand for volatility for NVIDIA. So this is last week. We saw a huge spike, and now it's moving down. Why? Potentially, we can explain this by huge demand across retail traders. We saw that last week, retail crowd broke all records. JP Morgan is saying that retail investors' sentiment reached the highest level ever. It's even above level we saw during the meme stock mania. And Goldman Sachs' Scott Robner is saying that they see the largest retail buy imbalance in the history of Goldman's data set. So at least for now, Sonali and Matt, we see that retail crowd and in hedge funds are moving in the same direction.
Positive momentum. We're going to switch back now to AI. And thank you, Natalia. Of course, that is Bloomberg's Natalia Knežević. Earlier, remember, we spoke to OpenAI's Chief Global Affairs Officer and asked about the emergence of competition from DeepSeek. Take a listen.
There are two countries in the world that can build AI at scale, the US, the CCP-led China. Yeah. And what that really means is that there is a global competition right now between whether the world's going to be built on small d, democratic AI rails, or authoritarian, autocratic AI rails. And that's the big takeaway from this.
Joining us now, we have the perfect voice to break it all down for you. That is Marty Chavez. He's partner and vice chairman at 6th Street. Can talk about this from the perspective of somebody deep in the technology world, as well as kind of on the forefront of finance, investing in this stuff. Marty, the DeepSeek moment. How do you explain this to your partners, to your clients? Are there going to be more DeepSeek moments ahead for the world of AI?
There's going to be more such moments, big moments that gets everybody's attention. And I'll also say they're going to be arriving faster. To my mind, DeepSeek is really more a story about open source, and then secondarily a story about quant trading, and then also a geopolitical story. But what's really impressive about what they've done is not that they've pushed the boundaries of science. I don't really see that that's what's happened here, but they've done some absolutely brilliant engineering, combined it all together, and then put it open source under the MIT license, and that really is changing the landscape. You have to say that in the future there's going to be more open source AI, and that balance between open and closed and proprietary, I would say, is going to head in the direction of open.
So we're hearing a lot of people in Paris kind of poo-poo the claim that it only cost them $6 million to build this model. It's very difficult to believe, right? I mean, that wouldn't even be enough chips to go in a set at $40,000 a pop if you expect the Hopper cost that much, and that's even the last generation. But the point is, Marty, they've done what we assume, they've done what they have equal to what ChatGPT is capable of, or Gemini, for far lower cost. Does that then make you think, when you hear that the 4 biggest hyperscalers in the U.S. are spending $300 billion this year, that they're overspending? Are these American companies throwing money away?
We need to really recalibrate that. Saying that they spent $5+ million on training is like saying I spent that much on electricity yesterday, without talking about all the electricity that I bought in the last year, and without mentioning the fact that I have a power plant, right? So yes, the very last training run probably cost that. I'm willing to believe that claim. But there's a lot of CapEx behind it. That cluster that they built on is well over $1 billion worth of NVIDIA chips. And so you shouldn't be confused by the training run at the end costing $5 million. That market reaction was incredible. They have done some amazing engineering. They've gone below the CUDA layer, and they've done things deep in the lower software layers called PTX, and they've done 10 other things, and it's amazing, but others have done similar things. The Google Flash models have similar cost and performance characteristics. So really, it's a story about open source. The thing that they've done that is completely different is taking all that work and putting it back into open source and starting with open source, starting with Llama, distilling it. I actually ran it over the weekend on my MacBook Air, not the full version, but the distilled version, and it is an amazing thing. But look, Jevons paradox has been talked about quite a lot recently. The clear reaction is if AI has gotten a little bit more efficient, and they've shown that, but others, such as Google, have also shown that, then we're going to be able to do more AI for the same price.
And we should also mention, of course, Marty, you are on the board of Alphabet, too, so somebody who would certainly know. So much of the market has been focused on the big tech giants and their spending when it comes to the world of AI, but I'm a little more interested in how this broadens out beyond just technology. Of course, you spent many years at Goldman Sachs as well, were very pivotal in the way it really transformed in the way it used technology, made systems more efficient. How is this new iteration here, or this next iteration of Gen AI, going to change finance?
Yeah, so Sonali, as you know, I've been in this world for a while. Weirdly, I got a PhD in AI in 1991 when we didn't even say the word AI because it wasn't working that great. And as amazing as this moment is, and it is amazing, AI is software. It's more software. We've seen versions of this before. You'll remember algos. We've discussed it a lot, maybe rolling back 10 years. Algos changed a lot of things on Wall Street, and a lot of buy and sell orders that people used to scream into the phone are all just done by computers. And there's been really a bifurcation. People who insisted on doing something that the computers could do better are no longer doing that. People who embraced the computers and said, well, I'm going to trade even bigger blocks of risk, have done extremely well. And really, it's important that we talk about AI safety here, just as we talked about algorithmic trading safety. Long time ago, we all realized you couldn't dictate how the algos should be written, nor could you prove that they're correct. But you could do things like make sure that there's capital adequacy every time you put a trade into the market. That's the market access rule. And that made things much safer. We absolutely need to do the same thing with AI. When these AI systems intersect with the real world, the stock market, the bank payments, any system you can mention, we need to have safety and standards applying at that boundary, just as we did with algos.
We're probably roughly the same age, Marty. I remember the first time I heard someone use Google as a verb. I remember covering the 3G license auctions in Europe. I remember my first BlackBerry. Back then, we thought that the telecoms needed to throw as much money as possible at this opportunity, right? And Brian McAuliffe, who's an internet historian, says telcos raised $1.6 trillion from Wall Street to do that, to lay fiber, to buy 3G licenses. But it took a long time for that to pay off. Now Moody's says we're going to spend $2 trillion on AI over the next 5 years, building that infrastructure.
The BlackRock estimate gets north of $3 trillion. You can get to $10 trillion pretty quickly.
So are we overspending? We've done it once, Marty. You remember it well, I'm sure. Are we overspending this time as well?
Look, I don't want to make predictions about the future like you. I pay a lot of attention to the past and to patterns. To put that $2 or $3 trillion in context, so the fiber optic spend was 20 years ago, and that was for a different thing. Look, I think AI is qualitatively different. Right there, we were moving bits around. We ended up using all that capacity. We're still installing capacity, right? And maybe it took longer to use that capacity than some people had in their plans, but we eventually used it. But here with AI, we're talking about something that is self-reflective. We're talking about something that builds on itself in a combinatoric way, as we saw with the DeepSeek models, building on the Llama models, building on a long history of research into transformers and other architectures. And this whole thing is going really, really fast. And the payoff, I would love to talk about healthcare, right? Some of the things we're able to do in healthcare now that we've only dreamed about things that we dreamed about 50 years ago that we actually solved, like the protein folding problem, and we're just getting started.
Right.
Yes.
Let's go to healthcare, because to the point that you're making here, it's often seen as kind of the next frontier. And so to the extent that you can really accelerate the industry via AI, where's the greatest promise?
So, well, picking up on this idea that we're now able to predict, given an amino acid sequence, the protein's shape in 3 dimensions, right? Well, that was an amazing problem. I remember in college talking about that with the professor and thinking, well, that might be 50 years, 100 years in the future. Well, that happened. Maybe took 40 years. But that's the lowest level. We want to be able to simulate not just proteins, but proteins interacting with DNA and cells and tissues and organs and bodies and societies with lots of bodies, and all the psychology about what makes you take a medicine or not take a medicine. That's what's at stake here, and that's what we can see a path to doing with AI and these other techniques, and that is unbelievably exciting. Now, will it take 10, 20, 40 years? I don't know.
I hope less. I think we're all pretty excited about it, Marty. So really appreciate your enthusiasm and your experience. Marty Chavez there of 6th Street talking to us about the development of this fascinating new technology. Coming up, we're going to talk about something pretty old school, and that's tariffs. President Trump looking to impose 25% levies on U.S. imports of steel and aluminum. Again, it's like deja vu, 2018 all over again. We'll bring you the latest next. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. Intel's newly appointed AI chief, Justin Hotard, has left the company to replace the CEO of Nokia in a surprise announcement from the Finnish company. Nokia has been in a prolonged slump in orders from phone operators for its network equipment. Hotard takes over at the end of March. The Philadelphia Eagles, you may have noticed, won Super Bowl 59, beating the pulp out of the Kansas City Chiefs 40-22 and denying them a three-peat. Meanwhile, Kendrick Lamar was the first solo rapper to headline the halftime show, and President Trump was the first sitting U.S. president to attend the game. I can't believe that. No other president has ever used his power to go to the Super Bowl. It doesn't make any sense at all to me. By the way, it is said that a penny saved is a penny earned, and if President Trump has his way, there won't be any new pennies at all. The president said he has ordered a stop to minting the coin because they cost a whole heck of a lot more than they're worth. The penny was one of the first coins made by the U.S. Mint after it was established in 1792. Today it costs more than 2 cents to produce each 1 cent piece. It's ridiculous waste. Meanwhile, Trump says he's planning on imposing a 25% tariff on imports of steel and aluminum to the U.S. from all countries. And joining us now from Washington to talk about this is Mike Shepard. So, Mike, I guess the question is, will he actually go through with it? Is this really going to happen?
Well, that's a great question, and it is one at the front of mind for every investor and really U.S. ally and adversary awaiting this move against metals, against steel and aluminum, because we have seen Trump drive right to the brink when it comes to his tariff threats, imposing and then pulling back 25% across the board tariffs against goods from Canada and Mexico, giving those two countries a reprieve and leaving them to negotiate further with the authorities here in Washington. Now, this idea of imposing tariffs on imports of steel and aluminum surfaced yesterday on Air Force One as the president was making his way to the Super Bowl. He said it would be coming today. There were very few specifics other than timing today, but didn't say when they would actually take effect. And he was also unspecific about whether there might be carve-outs, say, for industry or defense, which are two industries that are dependent on precious metals to produce what they need to do, and would also be very much in line with Trump's vision for America's first, too.
Speaking of America first, let's kind of switch gears here for a moment because, of course, tariffs are front and center, but so are a lot of the moves that are being made either by executive order or through the potential cuts that you're seeing DOGE take to. Of course, we have those lawsuits against a lot of those efforts as well. But I also want to point out here that certain places, Stanford, Harvard, top universities have also been warning here that there could be a potentially large hit to medical care, scientific innovation, they say, because of cuts to federal funding from the National Institutes of Health. When you think about kind of the ripple effects that are being had, what are the ones that are most immediate and in the forefront this week, as we're seeing kind of this push-pull between the White House, the closest allies to the president, and the pushback that they're getting from certain states and institutions?
Well, Sonali, that's a great question because we are looking for what is going to happen next. Elon Musk is going door to door in the federal government and moving from agency to agency, looking for places where he can, in his own words, look for savings and maybe even shut things down. It is part of that Silicon Valley view of move fast and break things. And people are worried that you cited the NIH announcement from late Friday night that they would be cutting overhead costs dramatically that are charged by these universities to NIH to help sustain the overall research and work that they do. And that promises to be a massive hit to the work of those institutions. But we're looking at across the board different agencies. We had some great reporting over the weekend on what's happening at the Consumer Financial Protection Bureau. And this is an agency that it was created during in the wake of the financial crisis. That it was spearheaded by Elizabeth Warren, the senator, Democratic senator from Massachusetts and one-time presidential candidate. This is an agency that's designed to protect Americans, and we're seeing it potentially being eroded. And there are a number of other agencies that are in the crosshairs, too. There are legal challenges to every single one of those moves, and we want to see how those play out this week.
Well, we give money to police forces in Haiti to fight gangs there. We give money to Honduras to fight MS-13. We give money to Colombia to fight narcos. And all of that funding from USAID has been cut, which, you know, the concern is that then drives more immigrants towards the southern border and more drugs into the U.S. It's a really interesting discussion and obviously a problem. Mike Shepard in Washington, thanks so much for joining us. Still ahead, Starbucks is trying to make your Monday after the Super Bowl easier. Is it tough? Are you hungover?
It depends if you're Patrick Mahomes.
I don't know. You think he was partying last night?
How hard can we go on him? I don't know. It's a tough game over there.
We'll talk about it next. This is Bloomberg.
Time now for social climbers. The company's making waves this morning. First up, Rivian, now selling electric vans to anyone who wants one. For several years, Rivian's van was exclusive to Amazon, and that deal expired in 2023. The move is said to boost revenue as demand for EV cars slow. Next, some Apple Watch users are reportedly wearing the device on their ankles to improve heart rate monitoring, especially people with smaller wrists. Unfortunately, the trend has also led to some misunderstandings, with some users saying that people are mistaking it for ankle monitors. And Brian Niccol, the real Super Bowl hero here. And from Super Bowl Sunday to Starbucks Monday, he's bringing you a free post-game day coffee to rewards members. The promotion comes despite plans by Brian Niccol to cut the number of deals by Starbucks. Now coming up, we're going to talk about ETFs because inflows show no signs of stopping. We're going to bring in State Street's Anna Paglia next. Stick with us for that conversation. This is Bloomberg.
'24 was a record year of inflows for ETFs, and 2025 is off to the races. Two of the main catalysts the spike in low-cost ETFs and a rise in actively managed. That's been really the flavor of the year. Last month, bond ETFs also had a huge rise, attracting $37 billion in inflows. Last year was $1 trillion in inflows, I think, in total, and we've done more than $111 billion so far in 2025. Anna Paglia is here with us, State Street Global Advisors Executive Vice President and Chief Business Officer. What an exciting industry to be in. Katie, I'm sure, desperately
I know we miss her today.
Misses having you here. But when do you expect this to slow down? I mean, it seems to me it's just like nonstop. Investors piling into ETFs. You know, we're finding new uses for this wrapper all across the industry. How long can it last, this run?
Well, why would you expect it to slow down? If you unpack the ETF wrapper, ETFs are a technology. And if you have an opportunity to bring a content in a better technology, why wouldn't you do that? And if you look at how the market has evolved, starting with ETFs only being a passive component and going all the way through embracing, emerging markets debt, fixed income, active. It is a powerful technology, so I don't expect it to slow down anytime soon, honestly.
I would love for you to really comment on what happened just over a week or so ago. Vanguard had raced to really cut fees on a wide swath of products, and I'm wondering what that means for the industry at large. Is this a signal of just how heated the competition is under the surface, or do you just see the more simple products going further and further towards zero anyways as new products are born?
So you touched on two very important topics. Competition is becoming more and more fierce. Not unexpectedly, more players are coming into the market. Active asset managers who for decades tried to stay away from the ETF market are now making a big entrance into ETF lands. So I think competition will be more and more fierce as we go. But price compression, fee compression is also part of the story. I think competition keeps us all healthy, keeps us all honest and on our toes. I do think that size and scale allows everybody to give back. And actually, I would be surprised if people didn't. I think that asset managers should give back. At SSGA, we have done it 167 times over the last 10 years. Not that anybody's counting, but if you do have a franchise that is giving you the size and scale where you have an opportunity to give back, you should. So I hope that this is something that is not going to be just the story of the day, but is going to be part of how this industry continues to evolve.
It's funny that it's kind of ironically, that was Jack Bogle's dream,
right.
And he was against it at first. Mm-hmm. If you listen to Eric Balchunas' Trillions podcast, they explain the whole thing from the beginning. But I was shocked to see the actual numbers on fee compression. Vanguard, their average asset-weighted fee is just 0.07%. I mean, that's almost just zero, right? Compared to the rest of the industry is 0.44%. We were talking about this in the meeting this morning, and the question arose, how can you pay, especially for actively managed ETFs, which obviously Vanguard doesn't really do that much business there, but how can you pay managers, fund managers, if you're only charging 7 basis points?
Well, again, technology and scale are the key. And I think it's also important to highlight that not all ETFs are created equal. So different strategies come at a different cost of production, so to speak. And you mentioned Vanguard cutting fees. Active ETFs have not seen that huge fee compression yet, only because there is a different pricing mechanism dictating how those portfolios are managed. Now, they are way cheaper than active mutual funds, which again gives you a signal about the efficiency and the effectiveness of the ETF wrapper. But there will be a range, passive low-cost portfolios are going to stay on the low end of the fees, all the way up to, senior loans, high yield, fixed income, active management. Those strategies will continue to demand a higher price associated with the cost of running the strategies themselves.
By the way, you at State Street Global Advisors and BlackRock and Vanguard, the three of you are basically own the entire market. But it's such a huge global market. We're talking about trillions and trillions of dollars. Obviously, we added a whole trillion more last year. Mm-hmm. Are you seeing a lot more competition seep in from other players?
I see more competition, and that is reflected in market share. You'll see that, the larger company keeps getting larger. At SSGA, our total assets right now are about $4.7 trillion across ETFs, cash, and retirement. So the large players will continue to grow. But the market share is a different contest. It's a different story. More players coming in, the market gets bigger, but market share will start to stabilize.
And something that really caught the fascination of a lot of the investment industry is the partnerships that you have been striking over at State Street Global Advisors. Apollo, for example, when it comes to a private credit ETF, of course, they're waiting for regulatory approval from the SEC. Then also Bridgewater with the all-weather ETF. How do you see this evolving? Are you in talks with many more money managers, hedge funds, private credit firms, alternative asset managers to make those kind of harder to access products more available to ETFs?
I'm glad you asked, because when I look at SSGA, I think about an asset manager with, you're going to laugh now, with the wisdom of a 99-year-old person, but the humility and the lack of ego of a 5-year-old kid. So our playbook is really simple. We know what we are good at. We know what we are great at. But we don't need to be great at everything. We also recognize that there are subject matter experts outside of what we do. We do well ETFs. We know capital markets. We know liquidity. And when we have a capability that we believe we want to bring to our clients, for which partnering with the experts is the key, we want to do that. When we decided to get exposure to digital assets, we partnered with a crypto native, with Galaxy, Bridgewater, all-weather, Apollo, private markets. So if everything starts with the client in mind. Whenever we think there is something that we want to bring to our clients, we decide, do we want to do it ourselves or do we want to partner with an expert?
And I realize there are probably some real limitations on what you could say about the Apollo ETF, given that it is still waiting approval. But what does it say about the broader inclination to add more private assets in the scope of an ETF wrapper, whether it's private credit or private equity? Do you think that this is going to take off? Will it be a defining feature of this year?
Well, ETFs have done just that. Looking back at the last 31 years, the mission of ETFs was one and simple, which was democratizing access to financial markets. Starting with equity, one basket, one trade, you get access to the market. Moving into fixed income, moving into emerging markets debt, foreign fixed income, all the way through what is the ultimate frontier now, is private markets. But, the ETF wrapper is not a magic box. You don't put anything illiquid in ETFs and it becomes liquid. You have to work on the entire ecosystem. And if you understand the ecosystem, there are certain things that you can think about. Now, we cannot talk about the Apollo ETF. As you said, it's in registration. I appreciate you had to ask. We cannot talk about it. So maybe we can do a deep dive in the future. But again, that concept of democratization is what is going to continue to drive the industry going forward.
Now, if they could only bring it to my 401k, because
I
look in there and I see all the fees eating up returns. And Anna, great having you on the program. Thanks so much for joining us. Anna Paglia there of State Street Global Advisors. By the way, tune in to our weekly show, ETF IQ. That is today and every Monday at 12 p.m. Eastern.
Now, I want to bring you some breaking news as well, because as we've been speaking, Microsoft has been hit by a French antitrust probe over Bing access. Let's see Microsoft shares reacting as well. It's still higher on the day, but of course...
At the highest level of the day,
at the highest level
So
of
the reaction
day.
has been to rise. Microsoft shares are up. No one cares about the French antitrust probe. But people do care about American Express speaking at a UBS conference and saying, We're confident with our full year revenue guidance. Okay, first quarter revenue is going to be lower than the fourth quarter, and those shares drop 2%.
Yeah, certainly. We are watching a significant reaction, actually even more of a sell-off now, almost 3%. We will keep an eye on all of these headlines as the day goes on. Stick with us. This is Bloomberg.
Let's get a quick check on what's going on in markets. We do see big tech stocks rising, adding to gains, especially on the NASDAQ. You can see there the NASDAQ up 1.3%, whereas the S&P 500 is up only 2/3% right now. Still better than a stick in the eye at 6,065. Taking a look at the U.S. 10-year yield, we continue to come lower and lower out of the danger zone. So now 445. We were looking at just 2 weeks ago, 460.
I told you, it's kind of breathtaking, isn't it?
Well, I don't know if it's breathtaking, but it is definitely better.
You have Scott Bessent, the Treasury Secretary, saying that he's paying attention to the long end of the curve. We're paying attention, though, to some stocks moving this hour. We're going to bring in Bloomberg's Bailey Lipschultz. He's going to kick it off for us with the steel stocks, because that's been seeing a lift all morning.
Yeah, we're seeing steel and aluminum stocks based in the U.S., operating in the U.S., rallying this morning. Among your best performers in the S&P 500, we've got Nucor and Steel Dynamics. This all coming in the wake of Donald Trump's plans to impose a 25% tariffs on all imports of the metals into the country. So you're seeing across the board the S&P Composite 1500 Steel sub-index jumping as much as 5.5%. Really strong moves higher. Granted, when you take things with a grain of salt like this, Nucor has been in a down and to the right trajectory, as have a number of these other competitors. So really seeing, maybe by the dip, a little bit of optimism about what this could mean for those U.S. competitors, just given the fact that if we see kind of higher spending here in the U.S., that ultimately helps their bottom line and helps their gross profit, just given that they can charge more. Yep. Obviously, America First seemingly the tone of the day.
Cleveland-Cliffs was down more than 50% last year.
Right, and U.S. Steel was up, right? So U.S. Steel's done great on expectations that they get taken out. It seems like no one's going to allow the Nippon Steel purchase, but
maybe an investment.
But maybe a big investment, and boy, do they need it, because they still make steel the old-fashioned way, which is to say the expensive way,
was
right?
Steel down 30% last year. Nucor another 30%.
Steel, the price of steel since the tariffs in 2018 has just been coming down, down. Let's talk about TD Schwab. I thought about you, Sonali, when this crossed.
Oh, you did?
Today, yes. TD Schwab selling a big stake. Sorry, TD is selling a big stake in Schwab. I think more than 10%, right? And that could raise what, like $15 billion?
$15 billion, which would be the largest share sale since we saw Boeing in the fall with that big raise, north of $25 billion when you include their mandatory convertible coupon. This big news, though, hitting the stock of Schwab down about 2.5%. TD shares, as you can see, up more than 3%, really reallocating proceeds right now. We're going to see Schwab buying back a chunk of those shares. We're also going to see TD using some of the proceeds to buy back their stock. So really kind of musical chairs, if you will, with some of that cash in that capacity. Obviously, this coming under new TD CEO Raymond Chun, their first big move. Again, issues with the company's kind of oversight of some of their issues domestically, but that's why you're seeing this play out and really kind of a reallocation of resources.
Yeah, tough run for TD, but of course investors like it today. Also investors liking McDonald's as well. What'd you see out of the earnings?
Comparable sales beating expectations, really strong across the board. This is the biggest move for the stock since 2020 when it was up 5.7% after earnings back in April 2020, beating expectations all over the place really for McDonald's. When you look at kind of what they're doing, comparable sales in the U.S. weaker than maybe they were seeing this time last year and weaker than expectations, but you are seeing investors going back into the stock.
You know, I also want to point out, real winner today, of course, tech stocks higher, NVIDIA. Finally in the green on the year, guys.
True. Year to date, NVIDIA had been down this morning. Sonali was telling me about it. Now they're up. Obviously, there's a lot of focus on AI because of the conference in Paris. But I think also fewer and fewer people buy that DeepSeek.
You said it, not me.
I mean, They say $6 million, and we were just talking to Marty Chavez of 6th Street, and he said, yeah, maybe, for the last training run, but that's only 150 Hopper chips.
Yeah, a lot of uncertainty, a lot of skepticism about how DeepSeek was able to kind of get across the finish line. Obviously, though, all eyes will be on NVIDIA earnings later this month. Implied one-day move after that, 9.3%. So really strong for potential company. Again, 5-day winning streak back in the green for the year.
What's this? I guess it's back, well, unchanged.
Right, it's been wavering. We're essentially flat on the year. We were negative. But it's interesting. The other piece of news overnight was that the main supplier of AI servers strengthened their first quarter outlook. So everyone looking for tea leaves into how well NVIDIA is doing. Bailey.
And what we've been talking about the whole show, the top 4 hyperscalers, the top 4 investors are investing even more.
Yeah.
CapEx, more than $300 billion this year.
Who benefits from that? NVIDIA. End of the day, all that really matters to that company is people continuing to spend up for those Blackwell chips. And that's going to continue to drive the growth. Again, boogeyman, though, is DeepSeek and the potential for cheaper capacity.
There's another bogeyman somewhere else as well. Bailey, we thank you so much for joining us. That is Bailey Lipschultz of Bloomberg News. We're also watching the bogeyman in the card industry, I guess, too. Is that fair to say?
Yes. Well, there's a UBS conference, and apparently American Express is speaking there and saying, like, okay, first quarter revenue growth is going to be worse than the fourth quarter, but we reassure you that we are still going to meet our full year revenue targets. It's only February, so if you already have to reinsure the market that you're going to meet your full year growth targets in February.
Right, and Amex tends to lead towards the wealthier customer. You are seeing shares now down 2.7%, but you're also seeing the other card companies, Capital One, Discover, also down in synchrony as well. We will be awaiting more comments from those firms and the health of the consumer. Interesting week ahead. Now coming up, part of that week, Fed Chair Powell said to testify before Congress tomorrow.
Humphrey Hawkins.
Yes, semi-annual testimony. We're going to bring you a preview from Bloomberg Economics next. Maybe we'll get them to weigh in on CPI as well. We'll see. This is Bloomberg. Fed Chair Jerome Powell will give his semi-annual testimony tomorrow before the Senate Banking Committee. Joining us now on what to expect, Stuart Paul of Bloomberg Economics. And if you thought about the cloudiness out of tomorrow's testimony, it would come from what the senators really push him on in terms of how tariff policy might impact inflation moving forward. And that's all, of course, before we have the inflation print on Wednesday. How are you going to parse through that noise?
So we know that Chairman Powell is probably going to open by saying that he needs to see the specifics of whatever proposals are put forward by the administration before making a substantive comment, and certainly before crafting policy. But if we refer back to, let's say, the 2018 Teal book, we know that internally within the Fed, they do expect some degree of drag to come from tariffs and a little bit of a boost to core inflation to follow from tariffs. But again, I expect Powell to sort of dodge as much as he can until further tariffs are implemented, perhaps in March.
Everybody talks about tariffs with regard to inflation, and there's a debate about whether that's, a longer-term driver of inflation or just a price shock, like one and done. But I don't hear many people talking about labor, especially with regards to immigration, right? If you're gonna take 1 million or 2 million people out of the labor force in a year, right? That's as many as Obama took out in 8. It's got to have a huge effect on wage costs, right? Am I wrong to think that that's going to be a crazy boost?
That's a reasonable expectation. It's really difficult to determine who's going to be asking that question, though. That's a particularly sticky topic. You would expect it to perhaps come from Senate Democrats. And you could expect Powell to respond by saying that at this point, the labor market is still solid, wage growth is still reasonably robust, and folks are starting to get some sort of a real wage gain. Unemployment rate is low and steady. So removing folks from the labor market, again, it could create those upward wage pressures.
By the way, blocking anyone from coming in.
Right.
Like the idea that we go from worrying about people coming in and closing our borders to competing with other countries for more immigrants is not a crazy idea.
That's right, but Powell's not going to bring up any sort of visa policy. He's not going to talk about high skill versus low skill immigration. What you're more likely to see, and where we could get some sort of a slip up from Powell that could provide some sort of an indication to markets what he's thinking about interest rate policy, would really just come from real pressure from Democrats to resume rate cuts. Right? It's that sort of line of questioning that's more so in Powell's wheelhouse, and where you could get him to trip over his shoelaces just a little bit by saying, oh, well, maybe another cut in the first half would seem appropriate, or we're expecting to maintain a prolonged pause through year end.
We were talking about this a little earlier. How much does the data matter at this juncture, right? Because in addition to this testimony, you have CPI this week, you have PPI, you have retail sales, and you have small business optimism. That's tomorrow. How much is the data overshadowed by the rhetoric?
So I think that the big item before CPI is really going to be the Senate Banking Committee hearing. We're getting that on Tuesday. I think that the House side, which comes after the CPI data, basically won't matter at all. The House side gets to be a little bit more of a circus. You're going to get questions about things like CBDCs, where Powell's going to completely take the air out of the idea.
Which is central bank digital currency.
That's exactly right. Where Powell has even said in the past that they're not even approaching the point of thinking about CBDCs. But those are the sort of topics that end up coming in the second day of questioning, going to be completely overshadowed by the CPI data, which is going to show disinflation stalling, which again, to the extent that any member of the House wants to pick up on that, great. But more likely, it's going to be just an opportunity for them to hit key talking points during the hearing.
We don't have time to talk about gold, which kind of bums me out. Because
we'll have time tomorrow to
the
talk about
idea
it.
that the Treasury holds millions of ounces of gold marked at $42 an ounce, to me, is insane.
We're richer than we think.
But the question is, if they mark to market, would that drive inflation? We'll talk about it during the commercial break. Stuart Paul of Bloomberg Economics. Be sure to stick with our Bloomberg for our coverage of Jerome Powell's Humphrey Hawkins testimony. That's tomorrow, starting at 10 a.m. Eastern, right here on this program. Before we go to break, let's take a look at markets. They are up on this Monday, 6,069 in the S&P. The NASDAQ, led by NVIDIA, up 1 1/3%. This is Bloomberg.